Welcome to the Stock Market Palantir channel. Don't miss any new stock insights from us by subscribing to our channel and drop any comments below. Okay, let's get started.
Friday's close told quite a story. Oklo Inc., ticker OKLO, finished the week at $80.50. We're looking at a market cap of, $12.44 billion? Now, if you pull up the chart, we are sitting right in this consolidation range, maybe between $70 and $115. But the really interesting number for me, the one that signals strength here, is that we are still up over 90% year over year from where this stock was sitting back in January of 2025.
And yet, if you zoom out just a few months, we're down roughly 50% from the October 2025 highs. I mean, people were paying over $190 a share for this. Anyone who bought that top has taken a massive haircut. The volatility is, well, stomach churning.
It is volatile. I'm not going to deny that. But context matters. I interpret this current $80 level as a classic basing phase. We're holding firmly above the 200-day moving average, which is sitting right around $77. Technically, that's a critical institutional support level. To me, this looks like a prime entry point. We even saw that 10.7% surge just last week when Texas Capital Securities slapped a buy rating on it with a $138 target.
Which was followed immediately by a 7.5% drop the very next day. You call that a base, I call that nervousness. I see this price action very differently. I see a re-rating. The market is finally waking up to the reality of the balance sheet. You have a pre-revenue company losing nearly $30 million a quarter, yet the market is valuing it at over $12 billion. It's priced for absolute perfection in an industry, nuclear energy, that has historically been defined by imperfection, delays, and, massive cost overruns.
I understand why you look at the burn rate and get skittish. If you evaluate Oklo as a standard utility play, the math, it falls apart. I'll give you that. But you have to shift the lens. This isn't a utility. It's a call option on the future of global baseload power. We're talking about a company that isn't just building reactors. They are building the energy infrastructure that the AI revolution literally cannot survive without.
Call option is a polite way of saying lottery ticket.
No, it is a calculated bet on scarcity. We have this widening divergence between the power grid's capacity and what AI data centers actually need. The grid is tapped out. Oklo is bridging that gap. They have a pipeline of over 14 gigawatts. They have a massive deal with Meta Platforms. This isn't a lottery ticket. It is a direct response to a desperate market need. The valuation is reasonable if you're looking at where they'll be in 2030, not where they are today.
But we're investing today in 2026. And my core argument is that this valuation is built almost entirely on narrative, not execution. You mentioned the Meta deal, and yes, it looks impressive on paper. But the market is ignoring the timeline risks. You have a massive regulatory bifurcation between the Department of Energy and the Nuclear Regulatory Commission, the NRC. We have all seen this movie before. Buying now is gambling that the regulatory environment, which has historically been glacial, is suddenly going to move at the speed of a Silicon Valley startup just because Sam Altman was involved for a while.
I think you're underestimating how much the environment has shifted just in the last year. The DOE isn't just watching from the sidelines anymore. They are actively pushing this. But okay, let's dig into the business model first, because that is where the real misunderstanding lies. Most people hear nuclear and they think of a massive utility company pouring concrete for 10 years, running over budget and begging for rate hikes. That just isn't the Oklo model.
Well, they're going to have to pour some concrete eventually. You can't 3D print a reactor.
Sure, construction happens, but the economic model is fundamentally different. They're operating a power-as-a-service model, or PaaS. This is the key differentiator. They aren't selling reactors to utilities who then have to figure out how to staff them and run them. Oklo designs, builds, owns, and operates the plants. They sell the electrons, not the hardware.
Which means they take on all the operational risk. If the plant goes down, Oklo eats the loss, not the customer.
And they capture all the margin. Think about the revenue pillars here. First, you have energy and heat sales. They have scalable units, 15 megawatts up to 100 megawatts plus. The Meta deal in Pike County, Ohio is for 1.2 gigawatts. And here's the kicker. Meta is prepaying. They're funding the early stage work, fuel procurement, site characterization. Oklo doesn't have to service high-interest debt just to get the project off the ground.
It is a great deal structure, I'll grant you that. Getting big tech to fund your capex is a coup. But you mentioned other revenue pillars, and I want to scrutinize those because I think the market is assigning value to things that don't exist yet.
They exist in the plan, and the investment is already flowing. Pillar 2 is fuel recycling, the Tennessee facility. This is a $1.68 billion investment to turn nuclear waste into fuel. But the one people really sleep on is Pillar 3, isotopes.
Medical isotopes?
Exactly. Through their subsidiary, Atomic Alchemy. Most people don't realize that the supply chain for medical isotopes used for cancer treatments, imaging, is incredibly fragile. It relies on aging reactors that are shutting down. By producing isotopes as a byproduct of their fuel cycle, Oklo taps into a market with massive margins. We're talking thousands of dollars per gram. It decouples their revenue from just the price of electricity. It stabilizes the cash flow in a way a traditional utility can't match.
Okay, but let's pause. You're describing a perfect scenario where they become a utility, a fuel recycler, and a pharmaceutical supplier all at once. Complexity is the enemy of execution. I'm sorry, but I just don't buy that it will be this smooth. Let's compare this to the competition. Look at NuScale Power. They're the most direct comparison we have. NuScale has something Oklo does not, an NRC-certified design. They have the stamp of approval. And yet, NuScale is burning cash rapidly, struggling to sell designs, and their market cap is under $6 billion, less than half of Oklo's.
Because NuScale is stuck in the old paradigm. They're trying to sell designs to utilities. Utilities are risk-averse. They don't want to buy a serial number 1 reactor. Oklo says, we'll build it, we'll run it, you just buy the power. That is why Oklo commands the premium. It is vertical integration. They control the fuel, the plant, and the sale.
Vertical integration is just a fancy way of saying we have to do everything ourselves. If one link in that chain breaks, the whole valuation collapses. And NuScale is using light water technology, stuff we have understood for decades. Oklo is trying to commercialize a liquid metal fast reactor. They're trying to innovate on the business model and the physics at the same time. That compounds the risk exponentially.
I disagree that the physics are the risky part here. The technology, the Aurora powerhouse, isn't some unproven sci-fi invention. It's a modernization of the EBR-2, the experimental breeder reactor that ran at the Idaho National Lab for 30 years. We have the data. This isn't theoretical.
We have data from a government lab operated by PhDs with a blank check, not a commercial fleet trying to turn a profit.
But the safety profile is what justifies the shift away from light water. You mentioned NuScale uses light water. That requires complex active safety systems, pumps, backup power, human intervention. The Aurora uses thermal expansion.
Walk me through that for the listener who isn't a nuclear physicist.
It's elegant physics. If the fuel overheats, the metal naturally expands. When it expands, the atoms move further apart. When they move apart, it becomes harder for neutrons to hit them, so the fission reaction naturally slows down. The physics shuts the reactor off, not a computer or an operator.
Walk away safe. I know the pitch.
It's validated. They demonstrated this in 1986 with the EBRII. They deliberately cut the coolant pumps, and the reactor stabilized itself without damage. Plus, it operates at near ambient pressure. You don't need those massive concrete containment domes that cost billions. That is how you get the cost down. That is how you make the unit economics actually compete with natural gas.
That is a compelling argument for the reactor design, I'll admit. But have you considered what you're going to put inside it? The fuel. The Aurora requires HALEU, high-assay, low-enriched uranium.
Which they are addressing with the Tennessee recycling facility.
A facility that won't produce significant fuel until the 2030s? We're in 2026. What happens in the meantime? They are completely reliant on federal stockpiles or Centrus Energy. If there is a bottleneck in the HALEU supply chain, and knowing the geopolitical state of uranium, there almost certainly will be, you have a beautiful, walk-away safe reactor with no gas in the tank. If there is no fuel, there is no revenue. Period.
Okay, that is a legitimate bottleneck, I acknowledge that. But that's also why the Department of Energy is so involved. The legislative environment has shifted to the American energy dominance agenda. The DOE is fast-tracking this.
They approved the Nuclear Safety Design Agreement for the fuel fabrication facility in less than 2 weeks. 2 weeks! That is the new speed of government when national security and AI leadership are on the line.
The speed of government is a fickle thing. You mentioned the regulatory bifurcation earlier. Let's dig into that because this is where the rubber meets the road. You have the DOE, which wants to move fast, and the NRC, whose entire mandate is to say no until they are 100% sure.
Right. And Oklo is navigating this by leveraging the DOE's authority for the initial pilots.
But eventually, they need the NRC for mass commercialization, and the NRC is a different beast. You're betting on a culture shift in a regulator that hasn't changed its culture in 50 years.
I'm betting on the fact that the U.S. government cannot afford to lose the AI race because of a lack of power. The incentives are aligned. But let's look at the people steering this ship. Because if you're betting on execution, you're betting on management.
Sure, let's talk about the captain.
Jacob DeWitt, the CEO, he founded this. He has been there since the beginning, 2013. MIT PhD in nuclear engineering. He is the perfect blend of technical expert and strategist. He knows the neutrons, but he also knows how to navigate Washington.
He also knows how to sell stock.
I expected you to bring that up.
We have to talk about it. It's the elephant in the room. On January 9th, just a few weeks ago, DeWitt sold over $10 million in Class A shares. Now, I know founders sell stock to, buy houses or diversify, but selling $10 million worth right after the stock had a volatile run-up? That signals to me that he might believe the price is topped out for the near term. If he thought it was going to $200 next month, why sell at $80?
He still holds nearly $1 billion in stock, 7.7% of a company. That is massive skin in the game. $10 million is a drop in the bucket of his total holding. He's diversifying, which is rational. You can't fault a founder for taking some liquidity after 13 years of grinding.
It's not just him, though. Look at the board. Sam Altman, the poster child for AI. He resigned as chairman in April 2025.
A natural transition as the company went public.
He reduced his stake by 33%. If the AI energy crisis is such a slam dunk, and Oklo is the solution, why is the CEO of OpenAI, the biggest consumer of this power, selling a third of his position?
Because his SPAC lockup agreement expired, and he is managing his personal liquidity. But look at who stepped in when Altman stepped back. This is the crucial point that the bears miss. Institutional ownership is surging. BlackRock increased their position by 67%. Vanguard is up 33%. These aren't retail day traders on Reddit. This is the smart money replacing the celebrity backing with Wall Street muscle. They see the long-term value.
Or they're just chasing the momentum of the sector in their index funds. Institutional ownership provides a floor, sure, but it doesn't guarantee success. They bought Enron too.
That's a low blow.
It's a reminder that smart money can be wrong. Let's talk about what success or failure looks like for the listener. We have people writing in asking if they should put $5,000 into Oklo right now. Let's break that down.
Okay, let's do the math. $5,000 at $80.50 gets you about 62 shares.
62 shares, right.
In the short term, next 12 months, we're watching for the criticality milestone.
Explain that. What does it mean for the reactor to go critical?
It sounds dangerous, but in nuclear terms, it's the moment of success. It means the reactor has started a self-sustaining chain reaction. It's alive. If they hit that target at the Idaho National Lab by July 4th, 2026, which is the goal, the bull case price target is $175. Your $5,000 investment becomes nearly $11,000. You double your money in a year.
And if the NRC delays the commercial license, or if the site characterization in Ohio finds a fault line, or if the fuel doesn't arrive, the bear case target isn't a soft landing. It's $14. Your $5,000 crashes to $900. You lose 82% of your principal. That is the binary nature of this stock. This is not a savings account.
I agree the downside is real, but look at the long term, 2035, the jackpot scenario. If they become a major industrial independent power producer operating that full 14-gigawatt pipeline, analysts project the stock could hit $1,211 per share.
$1,200. That implies a market cap in the hundreds of billions.
Yes. That turns your $5,000 investment into $75,000. That is a 1,400% return. That is why you buy the call option. You risk the $5,000 for the shot at 75.
That assumes everything goes right for a decade. No construction delays, no fuel shortages, no regulatory pivots. That is not investing. That is venture capital in public markets. You are asking people to stomach an 80% downside for a theoretical jackpot 10 years from now. Most people panic when they're down 10%. Can you imagine the emotional toll of holding this through an 80% drop?
I would argue that with Meta prepaying and the DOE mandate, the floor is higher than $14. But I agree, this is for the risk-tolerant portion of the portfolio.
It is extreme risk. And we haven't even touched on the cash burn.
They have a war chest.
They finished the third quarter of 2025 with about $920 million in cash, raised another $540 million. Sounds like a lot.
It is a lot. It's a massive runway.
For now, they're burning $65 to $80 million a year, currently. But they just broke ground at the Idaho National Lab. Construction is expensive. Those costs are about to skyrocket in 2026. That cash pile is going to melt faster than a snowball in a reactor core.
They have a multi-year runway even with accelerated spend. They're fine.
Look, I respect the technology. The Aurora reactor is elegant, the PAS model is clever, but the valuation is detached from reality. We are paying $12 billion for a company that is fighting a two-front war, one against physics to build the plant and one against bureaucracy to license it. The insider selling is the tell. When the people who know the most are taking chips off the table, you should be very careful about putting yours in.
I see the challenges, but I think you're missing the structural shift. We're in the early innings of a complete re-architecting of the energy grid. Volatility is the price of admission for a generational shift like this. Oklo was the only company solving the AI energy crisis at the source, with a business model that scales. Meta knows it, BlackRock knows it, and the DOE knows it. If you want safety, go buy a consolidated utility ETF and enjoy your 3% dividend. If you want to own the future of energy, you buy Oklo.
Well, 2026 is definitely the prove-it year.
We agree on that. We need to watch the site characterization in Ohio and, crucially, that DOE pilot program. If they hit criticality by July, the conversation changes instantly.
And if they don't, the price changes drastically.
That's what makes a market. So are you buying a utility company or a tech startup? We'll leave you to decide.
Until next time.
If you like this video and want to watch more content like this, then hit the subscribe button. It's totally free. Thanks for watching and see you in the next video.